Hello everyone. Let me introduce myself. My name is Rahelia Parwati. In this video, I will present material entitled Introduction to Liquidity Risk Management as part of an assignment to fulfill one of the requirements in the risk management course. Through this video, I will explain what liquidity risk is, why its management is very important, and strategies that can be done to deal with it. Let's start the discussion by first understanding the basic concept of liquidity risk. Introduction to Liquidity Risk Management, full paragraph. Liquidity risk management is an important aspect in the financial management of companies and financial institutions. Liquidity risk arises when an entity is unable to meet its financial obligations when due without incurring significant losses. The inability to meet these liquidity needs can lead to financial instability, decreased trust from stakeholders, and even bankruptcy. Therefore, liquidity risk management is a primary focus in ensuring business continuity and operational stability. Next is types of liquidity risk. 1. Funding liquidity risk. This risk occurs when a company is unable to obtain sufficient funds to meet its maturing payment needs or financial obligations. This condition can be caused by cash income that is not as expected or the inability to access external funding sources. This risk can cause the company to have to sell assets at a disadvantage to obtain quick funds. 2. Market liquidity risk. Market liquidity risk arises when a company has assets that are difficult to sell quickly without experiencing a significant price decline. When market conditions are unstable, these assets can lose their value or take longer to be cashed in. This can disrupt the smoothness of the company's cash flow and exacerbate the liquidity crisis. 3. Systemic risk. Systemic risk is related to liquidity pressures that occur throughout the financial system, not just in one company. If a major financial crisis occurs, all institutions may experience liquidity difficulties simultaneously, so that access to funding becomes very limited. This risk is usually difficult to control because it is influenced by broad external factors such as economic recession or political instability. 4. Operational risk. Operational risk is related to internal failures, such as human error, system failures, or weaknesses in financial management processes. For example, errors in recording cash flows or delays in collecting receivables can result in a shortage of funds that should be available. This risk can worsen liquidity problems if not handled with a good control system. The importance of liquidity risk management. Liquidity risk management aims to ensure that an entity always has access to cash or other liquid assets to meet all its financial obligations on time. Effective risk management involves cash flow planning, asset and liability management, and liquidity reserve strategy. With good management, companies can minimize the possibility of a liquidity crisis that can affect day-to-day business operations and the company's reputation in the eyes of investors and customers. Liquidity risk management strategy. 1. Cash flow planning and projection. The company must make accurate cash flow planning to ensure that liquidity needs can be met at all times. Good projections allow management to anticipate cash shortages before they occur and take preventive measures. 2. Diversification of funding sources. Relying on only one source of funding increases liquidity risk. Therefore, companies need to develop various sources of financing, such as bank loans, bonds, or internal financing, to maintain financial flexibility and resilience. 3. Provision of liquidity reserves. Providing emergency funds or easily cashable assets is very important to deal with sudden needs. This reserve serves as the first line of defense when there is a disruption in operational cash flow. So the conclusion is that liquidity risk management is a very crucial element in maintaining the operational continuity and financial health of an organization. Unmanaged liquidity risk can result in difficulties in meeting financial obligations, damage reputation, and in extreme cases, lead to bankruptcy. Therefore, companies need to have a deep understanding of the sources of liquidity risk, both from internal and external factors. Strategies such as effective cash flow planning, diversification of funding sources, and provision of liquidity reserves are the main keys in facing this challenge. In addition, it is also important to conduct regular evaluations and stress testing to anticipate possible crises in the future. With good liquidity risk management, companies can not only survive in difficult market conditions, but can also strengthen their competitive position in the long term. Awareness, preparedness, and proactive action are important foundations for creating a resilient and sustainable organization. Thus, the delivery of material regarding Introduction to Liquidity Risk Management that I can convey. Hopefully this explanation can increase our understanding of the importance of liquidity risk management in the world of business and finance. I would like to thank all my friends for their attention. I apologize if there are any shortcomings in the delivery of this material. Wassalamu alaikum warahmatullahi wabarakatuh.